All right. Hey, everyone. Welcome to another episode of Pitch Deck Insights brought to you by Visor. I'm your host, Litan Yahav, and with me are the amazing Hans Box and Mike Arndorfer. All of us have more than 120 LP investments, and each episode we walk you through pitch decks that were submitted by GPs who obviously gave us their consent to publicly do this review. We do not get anything for reviewing this. It's only for a sole objective to help you all become better passive investors, to choose the best investments and deals to invest in. So without further ado, let's dive into our next deck. This deck was submitted by Black Swan Real Estate. It's a fund. Disclaimers. We've seen enough of these. I haven't seen anyone where they have two. All right. Black Swan, just sort of the background about the fund. Invest in obviously value-driven, vertically integrated real estate. Have done $300 million in AUM, over 1,300 doors. All right. So that's the first company. And they have another company, Black Swan Living, basically, which is a property management company. I guess these are, well, we know Nick from our mastermind, but it's personal background. And we assume from this slide that Elaine, his wife, is part of the business.
That's the assumption. I'm assuming we're going to deeper bio on both of them, I hope, later on in the presentation.
All right, some background. Started in 2011. I've done single family homes, private debt, JVs. I've always self-managed.
I would say that's a key thing on this, but most of the rest of this isn't that important, but always self-managing, that's interesting.
What's the investor model versus Wall Street model? What does that mean?
Good question.
Okay, core values. Now about them in particular. Yeah, so here's your question, Hans, right? They've raised $60 million in capital.
Makes sense.
Looks like a single family brokerage, which is kind of separate from what we're interested in, but it sounds like that's also how they make their living.
You mean the Keller Williams?
Right. Yeah. Because that's one of the things you want to look at. What is the focus of the GPs? I prefer that they're not doing a W-2 or something like that still, and that they're just focused on this and have been for a while. In this case, they're vertically integrated, but one of the vertical integrations and streams of income for these guys is selling real estate.
Yeah. So I'd really want to understand who's running that sales team, that brokerage. Is that Nick or his wife? Is his wife is she employed still as a physician? It's hard to know here. It's not real clear on what they're doing, who's controlling that and how much time they're spending. I don't get a sense that they're full-time GPs from this.
The track record.
I think these appear to be more parameters than they do a track record. Hopefully there will be a true track record here later on the presentation, but I love the fixed rate debt. I don't know why full recourse debt would be a parameter. That doesn't make a lot of sense to me. No rate caps, which makes sense if you're getting fixed rate debt. So that's a given.
Blue ocean markets, I'd like to see what their definition of that is.
Yeah, me too.
I doubt that's true, but who knows?
And I don't know what incredible liquid reserves mean. That sounds a little salesy, honestly. If you say we need X amount of liquid reserves based on some sort of parameter, metric or actual number, then that's great. But it really doesn't mean a lot to me here. This slide doesn't mean a lot to me, quite honestly, other than I like that they get fixed rate debt.
Yeah, and the fact that they're also vertically integrated is a point to pay attention to, I guess. I don't know.
It's not incredibly important to me, at least not in the multifamily world, because there's plenty of really good third-party asset management companies. You don't need to be vertically integrated necessarily. It has its benefits and its drawbacks. I would hesitate to ever put in a presentation no capital calls ever. I mean, it's always a first for everything.
We've seen some from even things like insurance and stuff where they had fixed rate debt and didn't expect anything. Well, I don't know if there's been capital calls, but I've certainly seen distribution losses from insurance.
Investment thesis, high quality assets, amazing care of assets, infinite hold period. I wonder what they're going to do with this, like the infinite hold period.
That is kind of a signal to the investor that if you invest in this deal or whatever this fund, that possibly it may be a perpetuity kind of hold. I don't know. Hopefully we'll find out more.
There's times where I like that and some assets I like it, but other times you don't. It's just one of those to make sure that you understand it and understand that you're going to be leaving money in that and that 20 years from now, potentially you'll still have capital in this deal.
We'll see what they mean. I mean, this is like very high level thesis, right? Let's see what they mean in this fund particularly, but let's dive into it. How it works. Yeah, this is pretty straightforward. I don't even think we need to look at this, right?
So cash out refi in 3 to 5 years, targeting for 100% of your capital returned.
And you stay in the deal indefinitely.
Your assets are sold in 20 plus years.
Well, at least that relates to, their investment thesis and they're consistent, right? Okay. This is an important aspect of it. What that could look like. I think we don't really like these slides, right? That much.
It doesn't mean a lot to me. I really want to get in the meat of the particular fund offering.
Investor first model. I think we spoke about this before starting recording about, the no fee on the GP level. I think this is important. Just point to talk about for a second, right? Hans, anything you particularly you think about the no fee?
I mean, it's an interesting model. You don't see that very often. One question I would ask is, how are they funding them? My guess is, since they're basically making no fees and no splits until all capital is returned, they must be funding their lives through these other jobs, either the real estate brokerage and or one of them may be working, which is not clear here. So it's not a bad thing or a good thing. It's just a different way of modeling it. They do say before splits, but they don't say in here, at least on this slide, what the splits are. So I'm assuming we're going to find that out later, what the splits are. That'll be important.
Yeah, and the savings on this, I would say no acquisition fee. You typically see that 1.5%, 2%, anywhere from 1 to 3, probably asset management fee on multifamily. Depending on how you're looking at it, it's a lot of times 3%, sometimes more. Capital events, sometimes you'll get a redisposition fee of 1 to 2%, that sort of thing. So loan recourse fee, sometimes you'll see that as 1%. So I mean, this kind of stuff would add up to making a difference.
Right. I mean, at the end of the day, you want the GP to make money, right? That's where this is sort of like interesting, and look at it cautiously. Let's see what else they have in the slides. Explaining why they have an indefinite hold period. Obviously, once you get all your capital back, it's an infinite rate of return, essentially.
I don't know what it means by lines of interest beat value add. That doesn't have anything to do with how long you hold the deal. I don't know why it's inherently safer either. In fact, I'll argue that it's not inherently safer because you're not taking chips off the table. If I have an example of a deal that I sold in 2021, and if I was still holding it, the value would have actually gone down. And because we sold in 21, we took chips off the table. So I disagree completely with that inherently safer to hold indefinitely. They mean that they're not forced to sell. That's fine. That's what they mean. But holding it indefinitely or into perpetuity isn't necessarily safer.
I mean, you average out the market, Hans, right? Like if you're holding it for 20, 30 years.
That's not necessarily safer if you could sell it, take those chips and make a higher rate of return somewhere else. Just holding a deal isn't in of itself safer.
What I would say is safer is that the risk in a deal is during the value add stage. That's when most of your multiple is created, but then that's also where things can go wrong and you can have a problem. Once you've got a stabilized property that you know and understand well, and it's all rented up with the types of people that you're used to, it is definitely safer, but you're also earning a lower rate of return during that time. And that's what you give up.
That's what I mean by not taking the chips off the table and the market can turn on you. That's what I mean. Cap rates expand, it's gone. The money's gone regardless of how much NOI you increase. I don't know what huge financial advantages means either. I mean, every deal is so different. To blanket say that holding it indefinitely has huge financial advantages just doesn't necessarily mean much to me without more detail.
The tax advantages and depreciation, that I would agree with again, because as long as you hold it and you're getting your initial money back out with a cash out refinance, then you're not having to, it's not a sale. So you're not looking at having an event that's going to be something where you have to recapture that depreciation that you had if they are cost segging it up front.
Metrics, velocity of capital, payback period. There's a bunch of words to me.
Velocity of capital is great. Everyone wants velocity of capital. We prioritize equity creation over cash flow. I'd want more details on that. Quite honestly, cash flow is how you de-risk assets. And having an asset that will cash flow and receive cash flow as an investor is how you de-risk your investment. So again, this may be just interpretation, but I would definitely ask them for more detail about that.
I feel like we're really at the beginning of it, like page 16 out of 47. So I'm assuming there's going to be more like deep dive into all these information. Let's see. Black Swan Living Art. So this is their property management firm. 3% renewal rate.
What do you think, Hans? Is that high, low? What do you see? I see that as maybe average to a little bit below what I would normally see, or do you think that's good?
Pretty standard, I think.
Okay. I hear what we just talked about a minute ago, like why it's smart for them to be vertically integrated, right? What extreme ownership model means, eliminates layers. When they said the fees, I'm assuming the property management company gets paid for managing the property, correct?
As they should, yeah.
I'm guessing that Black Swan Living is making money and charging for a fee. It's just that as the GPs, they're not getting an additional property management fee on top of it, would be my guess.
And I guess it does give like more overwatch when you're both companies from an asset management standpoint. But like as Hans, you said, you could probably do the same thing if you have agreements with a third party property management firm as well, right?
Yeah.
Tax advantages.
That's standard by holding a deal longer.
One thing that's not double allocation of depreciation for investors at the $1 million level. That means that if you're not at the $1 million level, they must not be passing on 100% depreciation for your portion. That would be something I'd want to ask about, because if you're coming in above that, that's going to be an advantage. But if you are coming in below that, that's probably a disadvantage. Most, I would say, GPs pass along 100% of the depreciation to the LPs, but there are some GPs that keep a portion for themselves. So if they're going to do a 70-30 split, they'll take 30% of the depreciation and keep it for themselves. Or like in this case, it sounds like they're allocating different levels of depreciation for different tranches, like if you're an A class or a B class. And so I'd want to ask more about that, especially if you're going to be under the million.
All right. What if things go poorly? Rising interest rates, timing the refis. Well, because I said it's fixed rate, it doesn't really matter for them, right? If interest rates go up. Now it's sort of diving into the meat of like what they're looking to invest.
This raises eyebrows for me immediately. I am not a fan of a fund that has multifamily, single family, and short-term rentals in it.
It's very different. Rochester and Tacoma is fine as long as you're comfortable in those markets. But yeah, the short-term mixed in with long-term and multifamily with single family, they're very different.
So the diversification on the one hand decreases risk, but dealing with multiple assets along different geographies, different types of structures increases the risk, right? That's what we're saying.
Yeah, I'm not a fan of funds with all kinds of different assets, and in particular throwing in short-term rentals in there, and that which is in general saturated right now. And short-term rentals are more of a hospitality play, higher risk. I don't like that at all. If I'm investing in multifamily, I want to be invested in multifamily. It's okay to have multi-assets and maybe even in multi-geographies, but I want one type of asset. It's very different running a management company to run a 200-unit multifamily property versus running a management company to run scattered site, single family, and it's even more different to run a short-term rental.
Let's split that what you just said into two, because I understand the operational risk, and that makes sense. You're right, because you can't be great at everything. I understand that. But there might be people, investors, who want exposure to the overall real estate market without investing in a publicly traded REIT, and they might want to do this. And they understand the market risk, for example. I understand the operational risk, which is a different risk.
What you're saying, Litan, is that their investor may want that diversification. I think what Hans is saying is that somebody like Hans or myself, we would rather allocate a certain amount to a specific operator doing a specific thing that they're really good at, that they specialize in. And so that's just more personal preference that Hans is stating for himself.
I will also say, management company wise, it is completely different. I've seen it, and I've seen single family management companies try to run a multifamily property, and it's a disaster. So they keep saying they're vertically integrated, which is great, but they're vertically integrated, and how are they able to specialize in three completely different asset classes so well, is my question.
I think that there are some of the multifamily property managers who can be really good at build to rent single family, especially when you've come in and you've built it and all of the tile and all of the water heaters and all of the, everything's the same in all of them. But most of what this type of thing is what you said, scattered things across multiple areas, and every single dishwasher is different, and every single, tile is different and tub is different. And it's a mess, and it's really hard to manage well.
So again, that's all I meant. From the risk aspect that we were talking about is an operational risk. The market risk is something that people might want, but the operational risk is people have to take into account. This is increasing the risk because you're doing with multiple assets, different expertise, and that's a risk on its own. And I understand. Now they're diving into the two markets, right? Because they want Rochester and Tacoma, which also is a risk, right? Because two different markets, two expertise in those markets. And they're explaining why Rochester is a good place.
I'm sure it probably is a good place to be, but Blue Ocean seems pretty grandiose for Rochester, Minnesota to me.
So this is sort of like the layout of like what they're looking at in terms of
expansion community. So new jobs, new people coming in, that type of thing, which is something that's important. You want a market that's growing and vibrant. The fact that they're only giving us the Mayo Clinic expansion though, and maybe there's more, but it's one of those, like we've had some of our other slides where they gave us 20 different employers, and you do want to see some diversification. The good thing is that healthcare is unlikely to be cyclical compared to, say, like if this was in Houston and you were dependent on oil or something. But at the same time, if you're overly dependent on one employer and that's your whole thesis, you could have an impact if something changes with their health.
It looks like they have 12 properties already in the vicinity of what they're looking into now.
Do they? I didn't pick that up.
It says Black Swan Properties, and there's one here, the Colby on the outskirts was the 13th property.
Are these multifamily or are these short-term rentals?
That's a great question. It's possible. They're not saying here. They might the next slides. Nope, they're not. Let's just say they are similar properties. I think this is, crazy advantage of just having very concentrated area in one vicinity. With that said, the operational risk of different, I'm assuming that's not the situation. And these are different asset classes and types. And so that, raises the question that Hans said beforehand. And so did you. All right. Tacoma, so essentially higher household income.
Again, I'm not as interested in the overall. The market's great, but I want to know more about the sub-market they're buying in and the parameters about buying in certain sub-markets markets. What's their average median household income? What is their minimum population growth? What is their minimum job growth over the last 5 to 10 years? I want to understand what their parameters are for the markets they're buying in, not just generalities around Tacoma, Washington.
Hopefully we'll see that in a second. All right. Now they're diving into the short-term rental portfolio they have, and they started this less than a year ago, it seems. Have 19 short-term rentals, very small percentage of their portfolio, only 2%.
They're saying they could 10x it. I'd want to know what their plan was that way.
Well, it says unlikely it will be more than 20%. But yeah.
Yes, approximately 20% of the portfolio or less. But I don't like mixing STR in with other asset classes. And I certainly don't like being in a fund where they just started this. They don't even have a long tracker. They just launched it.
Right. This is a lot of information.
This is just affordable housing vouchers.
That's fine. If you know how to run this, that's fine.
I would say, though, in my opinion, a different skill set to appeal to and know how to value add a property that's scheduled for Section 42 or Section 8 tenants versus somebody who is, full market rate when you're trying to get maximum rents out of. But that would be some questions I would have is when do they add this in and do they have a good track record of sort of putting in the right finishes and things like that work in this and not over improving?
They're going over the portfolio that they currently have, probably under one of the previous funds, I'm assuming, right? So it's like 10% of the portfolio is this, 2% is that. And then they have this multifamily, which is where?
They don't know. It says closing in 60 days.
This is going to be the first property in the fund then.
Yeah, probably so.
It's weird that they're not sort of clarifying that.
What they're saying, this is a LIHTC property that is expiring out in a couple of years. So they're probably saying they have experience with that in their portfolio since this is the first asset in the new fund, maybe. The main value add is that the LIHTC rules are falling off in a couple of years and then they can get to market rate rents.
It looks like they have two options here. It's kind of strange. Phase one, do that or do a big renovation and do a second type of. So I'm not quite sure I understand here. Usually when I see a business plan, I want to see a defined plan of what they're going to do, not clear here.
Almost like they're going to stabilize things and then they may or may not do the big renovation.
May or may not obtain a construction loan. So we don't even know what kind of debt they're going to get yet, or, even what the structure is.
I wonder why they're giving this example of Bayswater.
I think this is what they're buying in the fund.
Yeah, it looks like.
That's what I would say too. Yeah, closing in 60 days.
There's another one.
And then this one, this is adjacent to Colby, which we don't know that, but
Short-term rental opportunity. So they are serious about doing short-term rentals. It sounds like this one's going to be STR.
so flip back to the slide that showed us those 12 and let's see if we can find the Colby. So it's not as close as I would have guessed. Like these other ones, like Uptown Landing or the Lofts, those would have seemed really prime for short-term rentals, with people staying for hospital stays and stuff.
May not be very far.
Yeah, it looks like maybe a mile.
So this is Bayswater, Uptown Apartment, same overall high level plan, like no detailed performance.
That one's a lot newer though. That one was built in 17 versus the other ones were the 70s, I think.
And then past performance doesn't seem like they're linking to a webinar, diving deeper into their past performance. Obviously, we're not going to go watch this now, but
There's a lot left out of this deck. I mean, they didn't even tell you what the structure is. What are the splits after capital's return? That was never mentioned anywhere here. Very using strategy overall, kind of choppy deck. I got a million questions.
all right, so hold on. So this is sort of like they're talking about historical performance, their recent cash out refi. All right, that's not really that. All right, cool, nice. And then the track records for the previous two funds, right? This is what we're talking about now is a deck for Fund 3. Now they're giving sort of an overview of Fund 1, Fund 2. The sizes of those funds when they close. So they've been doing this almost every year. The number of investors has grown substantially.
Yeah, it's hard to tell whether they're meeting pro forma or not here. I'd want to understand how are they doing against pro forma. Not enough information.
Yeah, it's too early. You've got a small amount returned in the first fund, basically nothing in the second, but there's no way to know if they're on track from this slide.
The rent roll.
They're talking about rent increases here. It looks like they're just talking about rent increases in 1 year. Okay, that's fine.
Is that high or low, Hans?
I don't know what their pro forma said. If their pro forma's 3, then it's high. If the pro forma said 10, it's low, right? It's in the kind of value add that they were projecting they would do. It looks like all of them here are increasing, but they've all leveled off, which is the entire apartment market, except for this last one, which looks like it's gone down. I don't know whether these performances are a result of what they've done in the value add component in their management or whether or not it's just the markets. So their rent grows. Yeah. I mean, again, it doesn't mean anything without knowing pro forma.
So this is where they're just sort of justifying the fund one single family homes, no vacancy.
Is there a Q&A that talks about splits?
This is probably a live webinar they did.
There's so many things they left out.
Yes, they did leave out a lot.
Just key things.
Right. Let's just go to the top, right? They talked about a few classes of shares because of depreciation. I'm assuming they have different fees, splits.
Yeah, but you don't know what the depreciation expectations are for either one. You don't know if they're sharing all of it or holding it back, what that looks like. Especially, I would want to know what the splits are after I've got my refinance back. I mean, that's something that should absolutely be in here, which the fact that they don't have it in tells me that it's probably really poor towards the LPs, especially when they emphasize that there's no fees. And maybe it's not, but it's something that should be there. And I'm going to assume it's not good since they didn't tell me.
Probably the structure of the fund from an LP perspective is probably the first question to ask here, right? From a return perspective, waterfall, everything is important to understand there. Second question I think that comes up from this is just sort of like there was this slide, we talked about what's in the fund, right? Oh, here we are. Just like totally different asset classes and sort of like understand better what capabilities they have to manage multiple asset types across different geographies, how it works. And there might be people like you, Hans, who don't like it as a fundamental aspect of investing, but other people who want it, they need to really understand how they're going to manage these different asset classes.
It's not a fundamental thing. It's fundamentally, usually you don't see a mix of assets like this in most funds. You just don't typically. So this is out of the ordinary, really, to have a mix like that in an asset class, especially putting short terms along with multifamily. Maybe short terms and single family makes a little bit of a sense. If it's not working on one, you change it to the other, so you have that flexibility. But multifamily and short-term rentals and single family are just different asset classes.
All right. What other things are key to what you'd want to see in this deck?
There's just not a lot of cohesiveness here, and I want to understand all the splits, like Mike mentioned, and I want to understand their parameters more. I don't have any idea what they're looking to buy. Are they looking to buy age, and what are the demographics they're looking for? Is there a minimum amount of rent increases that they need, over the current? I don't know anything about parameters, and there's no return calcs in here.
Nothing about cash flows. Am I supposed to expect any cash flows along the way, or is it just like there's not going to be no cash flow until refinances? And what kind of debt are they putting on? Since they're doing long-term debt, are they doing long-term fixed rate, and what does that look right now? Or are they doing something shorter term because they're doing the deep value add, they said? If it's a deep enough value add, they may not be able to get good long-term debt right away. And so there's a lot of questions left.
It's a long presentation with a lot of information, but there could be more relevant information or additional information they could have shared with us for us to get a better understanding of what this deck fund is really about. Anything else you guys want to add to this deck?
Well, and especially the debt wise, the two that they have under contract that I can see where they wouldn't know everything, but you've got two assets that are coming into this fund that are going to be closing in 60 days. And I don't know when this was done, but at closing in 60 days, you should have a good idea of what your loans are going to look like. Even not locked in yet, you should be telling me what the range is or what it's looking like.
And your strategy. The first one, they had two strategies and they were vastly different strategies. One was massive rehab. The other one wasn't very much rehab at all, which are completely different.
And even have to perform for each of these, right? Just we can see the numbers of what they plan.
What are their projected cash flows and IRRs for these various deals?
And how will they decide what to do? It really feels like maybe they have a very loyal following already and they just trust, Nick and Elaine to do what's right. But if you don't know these people and understand and trust them, this deck leaves out so many areas of trying to understand and know what they're going to do so you can get that level of trust that this is an operator that's going to do what I want and I understand it.
All right. Well, that wraps up another great episode of Pitch Deck Insights. A huge thanks to Mike and Hans for these amazing insights today, as usual. It's always a pleasure, guys. Stay tuned for our next episode with more investment insights. And don't forget to subscribe, share your thoughts below, and check out Visor to track and manage all your private investments. Thank you all for joining us. And until next time, keep investing wisely.